welcome to this week's education webinar. It's the fourth session of the Path to Professional Trading course that we started a couple of weeks ago, and it's a continuous program in order to increase your knowledge. So it's going to go from very basic levels to advanced level. So today we chose to talk about classical technical analysis. Last week we introduced technical analysis. What's technical analysis? So we're going to go over a definition again, and then we're going to talk about classical formations, trend lines, channels, supports and resistance, and after that my colleague Sai will be talking about continuation patterns and reversal patterns. So starting, what's technical analysis? Just to refresh your mind again. So it's a methodology for forecasting the direction of prices through the study of past market data, primarily price and volume. So a trader would be looking at a certain chart. Last week during the webinar we introduced different types of charts: the line chart, bar chart, candlestick chart, point and figure, and Renko charts. You can watch the video on ICM Capital YouTube channel. By looking at the chart, a trader will have a view or a look on the past performance of a certain currency or a certain financial asset. So you'll be implementing technical analysis. You will be studying the performance of the price, past performance, maybe look for certain patterns, use some indicators. Based on these assumptions, you will be able to set a certain forecast where the market could be heading. It's either to the upside or to the downside. So he'll be going for two scenarios, and he has to favor one of these two scenarios. Mainly, he will be only studying price and volume, and all the technical indicators that we see, or oscillators that we use, or we see some of the analysts use, or some of the traders, they all rely definitely alone on the price itself. And there is a key basic or key rule or assumption for technical analysts, that they do assume that the market discounts everything. So all the movements that happen in the market for certain incidents taking place, or for certain economic releases. So according to a technical analyst, the price will discount everything, or the market will discount everything. So there is no need for a technical analyst to have a look at releases or what's happening for fundamentally in the market. But definitely this is not the way to go. It's always advisable that a trader has to cover technical analysis, fundamental analysis, and risk sentiment. Technical analysis will always lead you to two possible scenarios, and by relying or by doing your job on the fundamentals, or by knowing what are the key movers on the market, or what are the key catalysts, they will help you to support or raise the probability of one scenario on the other. So we have a primary scenario and alternative scenario. So that's how a technical analyst should work. He shouldn't only be relying on a technical analyst. It means that he would be only relying on technical analysis. But a trader would definitely need to find different methods, combine these methods, increase the probability of a certain scenario, and then trade it. So the technical analyst will be looking for certain setups and patterns. My colleague Sai will be talking about the patterns. We have different types of patterns. We have classical technical patterns, the ones that were repeated a couple of times, and then they were solid for traders, so they've been in the market for like tens of years. And there are also harmonic patterns, which are also type of patterns, but they happen more often than these classical technical patterns. We'll definitely be covering harmonic patterns in the future. A trader also can use indicators and oscillators to have more information about the price performance. So a trader could be using classical technical analysis. He could be using the modern by implementing certain indicators or oscillators on the chart, or either they could be combining both. So he'd be looking for certain patterns and confirm these patterns by using indicators or oscillators. We all know, like from certain instant, that the certain market price moves from the price or market moves in trends, or sometimes we have like certain fluctuations. So definitely you have to know what is the trend or what's the current market performance. So whenever you want to trade, you have, for example, two strategies to trade. It's either you're going to trade a certain range where you believe like the market's going to consolidate in a certain range, or you're going to trade with a trend like you believe that the market's going to break to new highs or break to new lows. So these are there are mainly three types of classifications for trends: an uptrend, an ascending channel, downtrend, descending channel, or sideways and horizontal channel. The trend simply the trend is the direction of the market. There are some also assumptions that the market move in certain waves. For example, the market is going to go up and down, up and down. So this is, in general, this is an uptrend since we are going for higher highs and higher lows. So this is what makes an uptrend. So it's a series of higher highs and higher lows. And on the other hand, also a series of lower lows and lower highs is a downtrend. So by having this, you can, by witnessing lower lows or lower highs, you can detect whether the trend is down or up. So you have to look for the highs and the lows, detect how they are performing, or what are the highs and the lows that are being recorded in order to check whether the market is going in an uptrend or in a downtrend. Sometimes we lack catalysts in the markets, we lack certain directions, so the market will be moving within a certain range. So for example, we are in a certain range, we go for a higher high but lower low, and then the market continues to trade until we have a certain catalyst or a certain indicator or a certain release, for example, change in the fundamentals, market fundamentals or dynamics, that could lead to a breakout from the certain range, and then the market could be moving to a trend. So these are the main three market types or trend classifications. So it's either we have an uptrend, downtrend, or sideways trading. So this is an uptrend. It's showing that the market was here at a certain time. It was trading almost sideways, and then we had lower lows, 1, 2, and 3, with lower highs, 1, 2, and 3, and then the market reversed, and we started posing a higher low, and then another higher low, and then a high, and then another higher high. So here we had detection that the market could be reversing, and then the higher highs continued with the higher lows, definitely, and the market is in an uptrend. So this is how an uptrend is tracked. This is a downtrend. So the market was almost moving sideways here, and then we had a higher high, but then the market broke lower lows and lower highs was steep. So this is a movement down. Despite this pullback here, also we managed to post lower lows again, and the market continued lower. So this is a downtrend, and this is a sideways trading. In general, on the bigger picture, it's a sideways trading. On the smaller picture, you can see some trends. For example, here it's a downtrend. Inside the bigger picture, we have lower lows and lower highs, and then the market reversed, higher lows, higher highs, but then managed to break above this rectangle zone that we've been trading in. So these three charts, they are for the same instrument. So we saw the same instrument trading in an uptrend, a downtrend, and sideways. Now, how you can trade, or how you can draw the trend lines. So definitely trend lines, they are drawn by just combining consecutive highs or higher lows within the overall direction of the market. So you just set a line combining the lows. So in an uptrend, you combine, for example, let's say the market is moving like this, and then you have this point, this bottom and this bottom, so you have two bottoms, and then you come and draw the trend line, and the market moves higher. If you have a third pretest, then here you have two scenarios. It's either you buy or you sell. So here it's your decision-making point, and then based on some fundamentals, maybe you can just secure which is more likely to happen, and then you can have better results in trading. So this is a higher high, higher high, higher high, higher low, and higher low. So some of the traders, they trade trend, for example, they wait for this high to be broken to join the market. Other traders would prefer a certain drawback to the mean or reversion to the mean to join the overall trend. So this is an uptrend line. This is a downtrend line. This is showing the market going up. This is showing the market going down. This is drawn by combining the troughs or the bottoms. This is drawn by combining the highs. Trend lines and channels also continue. This is the trend line. So we can see here that the market was able to pause trend line 1, 2. We have 2 troughs. So I was able to draw this trend line, and then the market reversed back to the trend line here and moved upward. But here we had certain double top formation that Sai is going to talk about in a while, and then we had the break of the trend and the reversal, so the market moved lower. On the other hand, we have a downtrend line, also 1, 2. After this, I was able to draw this trend line, and then the market also bounced from the trend line 1, 2, another 2 times, making the trend line more valid, and then we had the break out of the trend line to the upside. So the trend of the break of the trend line or the violation of the trend line is usually taken as a violation for the trend. Trend lines and channels also continue with the channels. So trend channel is similar to what we drew for the trend line. For example, this is the downtrend. This is downtrend. We drew this downtrend line. So we just also draw another line by combining the troughs. So we have this channel to be parallel. So the market is moving like this, and we were able to draw first and the second. So when you draw, for example, two dots for the trend line, and you have another one. So for example, let's say the market is moving like this. Okay, so what I have to do is just I draw a trend line. I draw a trend line here, and I drew another parallel line here, and I expect the market to drop again towards this point and then bounce back towards this point until we have a violation of the trend. So this is how it happens. This is how we draw a channel. I'll be demonstrating in a while on the MetaTrader 4 platform. You can do it. So this is here. It's very clear how the market is moving within a certain channel. So I was able to draw the channel here, and then the market dropped, and then dropped another time, and rebounds from the channel, then dropped from the channel, then rebounded from the channel. So I'm using the channel borders as signals to trade, to buy and sell. Similarly here, 1, 2, I was able to draw 1, 2, and I do for a certain projection for the line. So I expect that the market is going to go. The fourth point is going to be on the channel. So when I have 1, 2, 3 points, I can draw a channel here, and then the market went up, then retraced, and then went up again, and then retraced. So I see that this channel is solid. So you can, for example, if the market is moving like this, so you have this move, and then the market is moving up again. So you can draw this line, and then draw another parallel line, and just set this line here, or the upper side, as a target for the market to maybe retest, or maybe and then have another retest, and then break higher and go for another channel. So this is how you can use channels to trade. So what are supports and resistances? So why do this point the channel matters? Why does this point matter, or this point matter? What happens if a trader uses a certain psychology for trading, or a certain rules for trading? They would force him to set certain orders. So for example, if I see a certain pattern taking place, or I see a certain price movement, or the price dropping towards a certain range, this will trigger me doing maybe setting an order in the market, maybe a buy order. Maybe if the market goes up to a certain price, market to reverse, I set a sell order. So these factors that they are triggering my intentions to join the market, they will lead to a certain point, which could be a point full of buying orders, or a point full of selling orders. These are the supports and resistances. So at the support point or support range, the buying force of traders is strong enough to overcome the selling pressure. Buyers become more inclined to buy. Buyers don't want to miss the opportunity to join the move. So when, for example, the market is moving like this, and then I have to draw a certain point. So I say if the market is dropping again towards this level, I'm gonna buy. So I'll set a buy order here. So the market goes down, for example, and goes back up, and the vice versa. So for example, I'm drawing this trend line here, and I believe that the market's gonna face certain resistance here. So I set a sell order. So the market goes up and then goes down again. So here I got a buy order, I got a sell order. This is what we call support, and this is what we call resistance. Resistance can be taken out of a trend line, can be taken out of moving average, out of a certain previous peak. So there are a couple of ways to detect supports and resistances. Also, you can use, for example, Fibonacci retracement. We're going to be talking soon about Fibonacci tools, which would help you also to set, for example, certain supports and resistance levels. So this is how support and resistance works. So support here, for example, if the market's going down, what I expected here is that the buying pressure will overcome the selling pressure that dropped the market here or drove the market here. And if the selling pressure is exceeding the buying pressure, the market's gonna move sideways and then continue lower. So this is where the support is being broken. So this is how it happens. So at support and resistance, it's just a fight or a battle between buyers and sellers that each one wants to take the price towards his good direction or his position. So this is the theory behind, or the idea behind supports. A support doesn't always hold, where a decline below that level indicates the sellers in the market have won out over the buyers, which I've mentioned now. Prices can sometimes break the support but stay trading near that level and turn back higher. This is what we call false breaking. So sometimes there are some traders, they do, for example, certain resistance levels and support levels, and then the market moves higher, for example here, and then it breaks above the resistance and then moves lower. So they trade, for example, they go for a sell trade here with a short stop loss. So the market triggers their stop loss and then it goes back lower. This is how you have to watch out for these filtrations, for these breakouts. You have, for example, to use certain filtrations like time filter or price filter. So you can use these filtrations in order to avoid certain breakouts. Similar to the idea of support, so this is the support here. So you can see that the market, so we have 1, 2, and 3 points. From this point here, you can notice that there could be buying pressure being in the market here at this area here. So you draw the support line or support zone. The market dropped here and then bounced back up, dropped here and then bounced back up again, dropped here and then bounced back up again. So as long as we go further and further and retest the support, it should weaken. So for example, here the market did like this, sideways, then the market broke lower. So as long as we if we retest support and resistance a couple of times, make it more vulnerable to be broken. Same for resistance, but on the other side, selling force of traders is strong enough to overcome the buying pressure. Sellers become more inclined to sell. Resistance doesn't always hold, where a break above that level indicates that buyers in the market have won out over sellers. And prices can sometimes break a resistance, but stay trading near the level. So it's similar to what we explained about support, but on the seller's side. So this is for support and resistance. My colleague Sai will be now talking about, before my colleague Sai join us, I'm just going to demonstrate on the platform how you can draw trend lines and channels. So it's very easy. I'm using here, for example, a 1 hour time frame chart for the euro dollar. So if I want to draw a certain downtrend or an uptrend, or for example, I want to detect certain support zone, so I can use here the vertical line, horizontal line, and the decoy, the diagonal line that I can draw it for the trend line, and here I have the equidistant channels. So for example, for the trend line, I have these points here. I can draw, for example, this target lower. So this is, for example, the trend line here. And for example, on the other side, if I want to look for certain supports, so for example, this was a certain support here near the previous low. If I was taking previous low in terms, so see how the market reacted here. It's kept for a while, then broke the support lower. Another support was near the previous low, so the market bounced exactly from the previous low here. So this is how you can detect support and resistance zone, and how you can draw them easily on the chart. Also, for example, you can go for drawing a trend line. So if you see here that the market was moving in an uptrend, we have a series of higher highs and higher lows for a while, and here we have almost stable low. So so you can also just go for the trend line, then you can draw the trend line here, for example, or you can just go for a better one. For example, here combining these lows here, and you can see how the market is now retesting this trend line. So this trend line was drawn by this way. So what you can do in order to draw a channel, you can just go like this. Then you just draw the channel. You can see that the market was moving in a channel, then broke below it, and then we retested the trend line, and now we're trading slightly below it. So it's very easy to just draw supports and resistances and trend lines and channels on the platform. Now my colleague Sai will be joining to talk about continuation and reversal patterns. Sai?
Thanks, Wael. Hello to everyone. Hope everyone's doing good. Let's discuss the next topic about continuation patterns. Basically, when I'm talking about the trend lines and the channels, which is a basic about how to identify some patterns. Major patterns which are here is like continuations patterns and reversal patterns, which are more likely to get some indication of the signals of the market's move. There are many traders or they like to go for this type of patterns quite to understand where exactly the trend going to be. So when you're talking about the first as a continuation patterns, these continuation patterns are an indication basically. Traders like to look for the signal that the price like to be remain on the same line. You know, if, for example, there is an uptrend and the markets pass, like the markets get some consolidations, and later on it gives a trend back again. So that is called continuation pattern. It can be either on a bullish trend, or we can say upside trend, or it can be on a bearish trend, which is a downside trend. So these patterns normally occurs every time in the middle of the trend. For example, when the market's been continuously, if you see last chart, which was shown by the Wael on a channel patterns, which was on a one side. So when markets moves on one side directions, and it will be formed the middle of the trend. So this continued patterns are majorly it's a price action for the traders. Usually they used to take advantage on the movements. Like, you know, for example, there is a big way in the markets on one side, and he like to take the opportunity back again to the market to know where the market's going to be corrected downside or going to be continue further on the same side. So this kinds all occurs mostly on all type of charts, majorly like all time frames. For example, you can see this patterns mainly on minutes also, like for example, like 30 minutes, 1 hour or 4 hours, or you can see on daily or weekly chart as well. So this patterns normally forms in two different type of signals. For example, when there is a trend happens in the markets, and when you see there is a triangle formation or flag formation happens, so that is clearly mentioning to give the indication of this continuous patterns. So when I say this occurs when price moves sideways after the formation of the trend, which is uptrend and downtrend. That's what I was saying. So this can be either side, which can give the formation on either side of the market sideways, which is on uptrend or downtrend. This continues the same direction as the previous trend. That's what there was a trend happening, and in the middle of the trend, it completing the pass and breaking the patterns. So which can be a triangle or flags. As I said, that it can be any way as it is. So this continuous patterns are three major types. One is the symmetrical, one is the ascending, as well as descending. So let's move on to the next, like we're going to see about the symmetric, how exactly the symmetrical looks like. So here you can see, before going to the descriptions, you can see this slides. So this how the symmetrical triangle looks. When I was talking about, which all happens in the middle of the trend. So when the downtrend happen in the markets, and there is a pass happen in the trend, for example, as Wael was saying, showing about there is a range which has follows the continuations of the market, which is giving some highs and lows, and it's quite lower than highs. So here you can see there's a downtrend, and there is this formation happens. As I said, like it can be a triangle or it can be a flat formation. So quite reducing the either side of the highs and lows. So same way, you can see this this symmetrical triangle, the neutral pattern formed by upper descending and lower ascending levels, continuing at least of 2 lower highs and 2 higher lows. Trend lines act as a support resistance and a break followed by a significant move. So usually this pattern breaks follows in a previous trend before the triangle happens. So which clearly shows that whenever the trend happens here, we can see there's a reduced inner heights of the lows here. So you can see there is the supports here. You can see the resistance patterns here. So resistance will keep resisting, lowering, and the support level are keeping up the different higher levels. So when these patterns come near to the level and it's get almost in a point, so that the breakout happens here. So there is since there is levels, upper levels of suppose have been keep increasing, we can see there is a levels happens. So these are the entry we can get into for the symmetrical triangle, where the entry starts here, and you can place a stop loss, or you can keep a stop loss here, or you can keep a stop loss here, which majorly act as a major resistance levels. So this is how the trend is going to follow when this type of patterns normally happens. Same way, exactly opposite for a upside trend, when there is an upright trend has been formed, and this type of symmetrical triangles forms. And same way, and there is an entry happens in this level where it follows with a major supports like 1, 2, 3. And you can, as depends on the trader's risk management, you can choose your stop loss either here or here, or you can place here, and trend can be continue further on the upside direction. So this is one of the type of patterns on continuous patterns. And we're talking about the ascending triangle. So here you can see a bullish pattern is formed by a horizontal upper line with equal highs and an ascending line with a lower, higher lows. So buyers outweigh the sellers to the extent they're pushing price higher and they're breaking the upper resistance line. So here you can see that from the slides very clearly shows that the resistance of the points remain the same. For example, these are one, the second resistance, the third resistance, but the trend of the upward trend of been continually being falling up to increasing the support levels, like this is a support 1, support 2, support 3, and these formations remain the same when the resistance plays a major roles. As I said, like resistance suppose are the very important tool for any technical analyst, so which plays a major role here based on a trend or maybe with the channels. So here we can see when there's a breakout happens on a major resistance level, so this could be the entry level to be on a upside trend. So as I said, like you can keep here as your entry and looking for the major targets. This target can be defined with different indicators. We are going to upcoming webinar, we're going to see all those type of indicators, how to define your targets, how to identify targets. Even the last webinar we had discussed about the Fibonacci retracement. Using that Fibonacci retracement, we can extend, using the extension type, you can find out your target levels, as well as you can keep increasing, trailing your stop loss based on that. So these are one of the ascending triangle. Usually this happens in many of the markets movements, basically hourly charts, even at short-term traders, you can use 30-minute charts. It's very effective one of a way of indications. Usually markets give this type of indicator because any technicals before going to jump into the indicators, the trend lines and channels are very important to understand. So to know about this more deep into this knowledge, to understand the indication, the signals of the patterns, you should be very clear how the trend line works, how to draw the trend line, how to plot the trend line, how to identify the major support levels combining with the different time frames. So these are most important things. So let's move on to the descending triangle. Exactly, when we're talking about the ascending, it's exactly opposed to the descending descending triangle, which is a bearish patterns, which are formed by a horizontal line with the equal lows and descending line with the lower highs. It's basically a mirror image of ascending triangle. As I said, it's the opposite of ascending triangle. Sellers are more aggressive and push price below the support line. You can see this. You can see this slide, which easily understand that how exactly the trend line, a downtrend has been formed, and later on the major support has been maintained. For example, this major one, maybe you're not able to find out the support here. Later when this has been market came and bounced back slightly, we can able to see a major support, like so we can see support time as one. Second time, it touched bounce back and third line. So it's always it plays a major role of the supports here. So when this lines has been broke down, so definitely there will be a continuity on the downtrend and keeping as this as a stop loss. So these are the major three type of continuous patterns. When I'm talking about the reversal patterns, as I said, that reversal pattern is completely against pattern. For example, what we've seen is the continuous pattern is nothing but the trend is going to continue in the same direction. If it is a bullish, again, there's a pause happen in the market and give some type of a triangle or flat formation. It's going to continue in the same way. and a downtrend, it's going to be the same way, it's going to continue on that. But the reversal pattern is completely entirely different, and there's a very effective way of patterns, because this is a major move happens in a long-term time frame. For example, a trend changing patterns basically usually occurs in a long-term way. So this reversal patterns also, like if you're seeing a upside trend and there is a patterns happen, it's going to be a downside trend. If it is a downtrend, its downside trend is going to be an upside trend. This is mean called reversal patterns. So it normally occurs at the end of the existing price move, suggest a change in the direction of the price trend, which is a positive or negative. So there are three major type of continuation patterns are there, a reversal in this. There's a head and shoulder, a double bottom, or triple bottom, or we can say three other major things. So once we look into the head and shoulder, it's very clearly shaped from the word, like from the name, like it's head and shoulder. So where you can see there is an uptrend happens in the markets, and there is a form of a consolidation which maintains a same support level, and it's again forms to the high, which is maintained the same of two other levels, and going to break at the lower support, and it's going to continue. So here we can see in a simple way, like you can see here, let me give you the descriptions about that. So here, like it's very clearly shown in a candlesticks patterns, like candlestick chart. So these all act as a shoulder. Two act as a shoulder, with this act as a head. So when you see there is a breakout happens on this particular level of resistance, it's going to continue on the upside directions. So same way, when you're talking about the reversal side, like we're talking about the, for example, inverted head and shoulder patterns, when there is a downtrend happens and its markets give this type of indications, like if you see the strong resistance plays in the major role, and it's once breakout happens in this level, it's going to continue on the upside direction. So if this two act as a shoulder, and this will be act as a head. So this normally happens in many patterns. If you closely watch about the charts and you measure charts in a long way trend, this is a very effective one, because it's going to continue further, because where the market has started from, where the market is dropping, so it may continue to lose the same level. So keeping a reasonable stop loss over here, because this plays, as you said, there's a major resistance support to be placed here. So we can continue with the same trend on both the side directions. So this is one of the patterns. Coming to next to that, we can see there is a double top or double bottom patterns. Normally they say it's like a double, it's mainly the M or W-shaped reversal patterns, because formation looks like that exactly. Before going to some charts here, like there's a M patterns and W patterns here. For example, a market is in an upside trend, quite it forms a type of correction happens. This correction can be identified by using Fibonacci retracement, as we are discussing last week. So by using this, again, if this failed to break, for example, in tape of gold, which is 1,900, and market corrected to like 1,870 or 880, and market couldn't break again further 1,900 levels, so it's back to again to the same level. So it seems to be a major support. So once breakdown happens at 1,870 or 880 levels at the support, is going to continue further. So it looks like a M patterns. So it's also one of the effective one, because usually happens the double top bottom and double top is usually happens on a yearly, weekly charts, or maybe lower time duration. Even it occurs on a 15-minute, 30 minutes time frames also. And same way for the double bottom, same way it looks a double bottom here, and this is how the plays a major role to enter the levels, because it's since maintain the same resistance. Once it's broken that level, and it's going to continue further on the upside direction. So those are one of the patterns. And coming to the triple bot, exactly the same as the double bottom. Here we have seen three highs and two lows here. So as we see that double, it comes to correct and it start entering at this level. But in case of triple bottom, you get one more levels of entry, wait for entry to enter. So because it forms a second time, but you'll be waiting to enter here basically. For example, if the market moves like this, and you may be trying to enter here, but not happen, since it maintains the same resistance breakout, and when the correction happens from there, and market back to the same level of this support, and couldn't able to break. So obviously it's going to form again. Same, the third time it couldn't be able to break the high. For example, take for a gold, we are talking about the last slide, which is 1900. So it couldn't be able to break the 1900. So it market back to the support again. So it broken out. So this form has a triple bottom. So once it start breaking at this level, it's going to continue on the downside direction. As I said, stop loss can be fixed or depend on your money management. Either you can fix over here, or we can try to reduce it, or we can place a different daily support level or resistance level. Keeping on that parameters, you can keep your stop loss. But these are exactly the triple top bottom works. Opposite to that, exactly the triple bottom will be working on it. In case of downtrend trend, we can see there is a levels happens 1, 2, 3, and this all became a major support. When started breaking out the resistance, important resistance level is going to continue on a upside directions. So these are the major two types of patterns to be mostly occurs in the markets. So which helps you to find the signals on a trendy wise. One can be continuations, or one can be on a reversal side of directions. Thank you.
Thank you, Sai. So in order to just to draw these patterns on the chart, you better go for the platform. Just you have to look them up, or if you have the plugin for AutoChartist, you can also use it. It could help you in detecting certain price formations or certain patterns, like Sai was like the ones that Sai was talking about. So so this is it about the channels. So for example, about the patterns. So you have to go for the charts and try to look for these patterns, for triangles, support and resistance, for triangles for tops and bottoms, head and shoulder. So they happen frequently on the chart. So for example, this one formation, some of the traders last week were a bit assuming that we could be going for a bigger head and shoulder pattern, or a head and shoulder with complex shoulders. So but it's not very clear pattern, it's not very solid pattern, but this was on the wire for some traders. Also, you can just for example, if we go for gold, there was a pattern that everyone was talking about for a while. I'm just gonna delete these lines. These lines I drew them yesterday when we were explaining something in the Arabic webinar, and to see how the market respected trend lines. So we had a reversal from this trend line, and then the market moved lower towards the trend line that was combining these two lows, and now we reversed back to the upside. So this is a clear example that classical technical can give you solid, or can give you good trading signals in the market. So just for example, for some of the patterns, like for the descending triangle, so there were some talks that this is a descending triangle, and then the market dropped here, and then it was lacking certain drivers, and then the market moved higher again. So we face a lot of patterns during the day on smaller time frames, and even on bigger time frames, they take some time to last, for example, or some time to form. But definitely you need to study the probability of occurrence or the solidness of this the pattern. For example, here we had also a triangle pattern before the market moved to the upside, or a flag pattern almost before the market moved to the upside. So it was a certain continuation form. Then the market continues. So we had an ascending triangle, and then the market break above this ascending triangle and continue. And also here we had another ascending triangle, and the market was able also to trade again. So see, this is a gold chart. This is the daily chart, the H4 chart for gold, and you can see how the market, when the market was moving to the upside, we had two ascending triangles formation that signaled the continuation for a certain trend. And if you just go for a bigger picture, so there are some talks currently, some expectations that the market could be heading for another formation here, but we need a bit of more time to have it formed clearly. Also, there were some talks about this possibility. So there are a couple of ways that you can draw the triangles in. So this is also a triangle, but then here we lack like more solid bottoms. But here, for example, we have 1, 2, and 3 for the descending. Or you can just draw this triangle and then have the level here for support, so you can trade them both. So you have to so for classical technical patterns mainly, you have to look them up on the platform and try to find them. So this is all for today. If you have any questions, please write them down. Okay, so usually for intraday there are some good formations on the 5 minutes chart, but also it's better to use, for example, 15 minutes chart for more solidness. Usually the patterns that they are formed on 15 minutes chart, they are better, but definitely between the 5 minutes and 15 minutes you can find almost the same patterns. It's just when you are drawing the patterns, that's almost related mostly to price, so it doesn't matter between 5 and 15 minutes, but usually 15 minutes is good for intraday. Perfect. I believe this is it for today. Thank you all for joining, and wish you great trading throughout the end of this week. Sai, would you like to add anything?
All good. Thank you, everyone.